Welcome to another episode of China Update, where I provide you with the most up-to-date political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Okay, happy Monday everybody. I hope you had a restful weekend, and I wish you a productive week ahead. It's Monday, so it's an economics-heavy episode. Over the weekend, we saw the publication of new official data, much of which was rather disappointing. China's retail sales grew at the slowest pace since 2022, while industrial production accelerated, highlighting the unbalanced state of the economy. According to the National Bureau of Statistics numbers, consumer spending expanded 2.3% in April. That's down from 3.1% in March, and worse than economists predicted. Industrial output rose a faster than expected 6.7%. As we know, the government has reallocated capital from infrastructure to manufacturing, the fruits of which has had to be exported due to weak domestic demand, a move which has exacerbated trade tensions with key partners. Quote, year-to-date industrial output was up 6.3% and retail sales were up 4.1%. How do you reconcile surging production with dragging consumption? There are only two ways. One way is to force further expansion and investment, which was up 4.2% in the first 4 months of the year. But boosting investment further isn't easy. The other way to reconcile surging production with dragging consumption is, of course, with a surge in a trade surplus. And, not surprisingly, China's trade surplus is indeed extraordinarily high. But for China to continue relying on a surging gap between exports and imports to resolve its weak domestic demand requires that the rest of the world allow its own manufacturing capacity to wither. Needless to say, the world is becoming increasingly hostile to this requirement. End quote. Fixed asset investment grew 4.2% in the first 4 months of the year, as he said, a mild slowdown from the previous numbers. But investment in property development plunged 9.8%. China's economy has shown mixed signs of a recovery in recent months, with exports returning to growth in April but domestic sentiment struggling under a deep slump in the property sector. The People's Bank of China began selling 1 trillion yuan of ultra-long bonds on Friday in a bid to, quote, give full play to the critical role of government investment in shoring up economic growth. End quote. In Saturday's video, we also discussed the huge property support measures rolled out on Friday and their implications. Next up, yesterday, Sunday, China's Ministry of Commerce announced that it is probing imports of polyoxymethylene copolymer, a thermoplastic widely used in the consumer electronics and automotive industries, from the EU, the US, Japan, and Taiwan. The move suggests Beijing will take tit-for-tat action against foreign trade barriers, but, quote, the narrow investigation into chemicals also highlights the limits on its ability to respond, given the huge trade surpluses it runs with the US and the EU, end quote, in the words of UK-based The Financial Times. This action comes hot on the heels of the Biden administration last week unveiling a raft of tariffs on Chinese goods, including clean energy technologies and computer chips, including the quadrupling of tariffs on electric vehicles to 100%. Canada's Trade Minister, Mary Ng, soon after confirmed that her country is examining whether it also needs to raise tariffs on Chinese-made electric vehicles. The EU has also launched several probes into Chinese exports in recent months, including into wind turbines, solar panels, and Chinese electric vehicles, amid accusations that Beijing was supporting the industry with huge state subsidies and flooding the European market with cheap EVs. Yesterday, the European Commission said it will, quote, carefully study the contents, end quote, of Beijing's investigation into the chemical imports, quote, before deciding on next steps, end quote. Next up, this is the main part of today's video. Richard Ku is a Taiwanese economist who heads the Nomura Research Institute in Japan and has advised several Japanese prime ministers on economic issues. He is well known for coining the term balance sheet recession as an explanation of Japan's so-called lost decade or lost decades, a long period of stagnation after years of explosive growth. Whereas a typical recession is considered to be a natural result of fluctuations in the business cycle, a balance sheet recession is characterized by high levels of private sector debt that led to increased savings, which in turn results in an economic slowdown because of reduced household consumption and declining business investment. In recent years, Chinese and foreigners alike have sought Ku's thoughts on China's economic outlook and whether the world's number 2 economy faces a similar fate. Ku's voice is one of several leading figures in China's economic debate. Regular viewers will notice that some of his policy recommendations differ from, say, Michael Pettis' school of thought, as well as others we have examined. It's important to follow all major arguments on China's economic outlook. Today, Monday, Hong Kong-based South China Morning Post published a long interview with Ku to discuss this very theme and warns of dire consequences for China's economy. To end today's video, let's examine some parts of the extended interview. But before we dive in, if you're enjoying today's video, getting some value from it, don't forget to hit the like button. Subscribing is a big help too, and Patreon and Buy Me a Coffee links are in the description below for those who want to help keep the channel financially sustainable. Let's begin. Question. Mr. Ku, in the midst of economic uncertainties fueled by high levels of indebtedness and a real estate crisis, 2 potential causes of which you deem a balance sheet recession, what are the risks that China might be facing such a predicament? Answer. I have been invited to speak on numerous occasions in mainland China and have participated in some policy debates. A lot of economists worry that China may slip into a balance sheet recession, but there are also other views out there. Some say the economic problems are about structural reforms, nothing to do with balance sheets. They argue that if we just do a little bit of monetary and fiscal stimulus, everything will be fine. Those were the typical arguments we heard in Japan 30 years ago, when the troubles began. The country constantly tried all types of structural reform policies, but it took 20 years to come out of that mess. The United States, on the other hand, had those arguments too during the onset of the recession following the 2008 financial crisis. But within the first 2 years, former Federal Reserve Chair Ben Bernanke read my book and realized that it was a balance sheet recession. Once he realized it, he started pushing for fiscal stimulus, with the famous phrase fiscal cliff, which went against his original judgment that monetary policy alone could solve all those problems. So the US came out of the recession relatively quickly. Top European policymakers did not buy the balance sheet recession theory at all, so they kept on pushing for structural reforms and wasted years. Europe took almost twice as long as the US to come out of the same balance sheet recession. So, if you put the right policies in place, you come out of the recession relatively quickly. But if not, you could be stuck in there for a very long time. Question. So your advice is that Chinese policymakers should look at how to reduce the risks of balance sheet recession and commit to acting on related measures now? Answer. Yes, on the size of the fiscal stimulus, I say when you're going to make a mistake, make sure you make the mistake of having the stimulus too big instead of too small. It has to be big, because a balance sheet recession can kill the economy very quickly. If the stimulus is too small, the economy starts weakening quickly, and only at that moment do you decide to implement a bigger one. The cost will be much larger than had you started with the right amount in the first place. If you allow the Chinese economy to suffer a very bad affliction, and then you will try to help it recover, the consequences could be dire, given its sheer size and the weight it carries globally. The response I get from those skeptical about the balance sheet recession in China is, we tried a big stimulus in 2008 and that created all sorts of problems a few years later, so we don't want to repeat the same mistake. This seems to be the main consideration nowadays. Here is my counter-argument. When the Chinese government announced the 4 trillion yuan package in November 2008 to maintain 8% growth, economists around the world were laughing. They asked how China could maintain such growth with a great dependency on exports when the whole global economy was collapsing and Chinese stocks by then were already down 70% from their peak. But 1 year later, China recorded 11.9% growth in Q1 of 2010, and nobody was laughing. That growth helped restore confidence in no small way, because people had thought that China would go down just like the US, Europe and Japan, and more confidence helped increase consumption and investments and got the economy moving again. The 4 trillion yuan package, of course, was a bit too big down the road, with too much debt and overinvestment. So, the lesson is that you put a big stimulus first to win back confidence that the government can maintain growth, and then, once you get the economy moving again, you start reducing your stimulus. In the 2008 experience, China recorded much higher growth the following year, so China should have started cutting back the package. I think this is also what we need today, a big package, and the package should be for a long term to assure people. I hope China will not repeat the same mistake of removing stimulus prematurely, particularly when the private sector is still repairing balance sheets. Only when private businesses are coming back to borrow, that's the time to remove a stimulus. Specifically, to begin with, Beijing should do whatever it takes to complete all unfinished homes. Question. China faces deflation pressure, and you have written about the risks of demographic threats and its shrinking labor force. It appears China has all the symptoms that Japan experienced 30 years ago. If China is facing Japanification, what lessons can it learn? Answer. What China is facing now is a combination of stagnation and a shrinking, aging population. Japan's population was still increasing for 19 years after the bubble burst. But in China, population decline and the bursting of the bubble started roughly at the same time, around 2022-2023. So the Chinese situation is far more serious than that of Japan 30 years ago. For home buyers with borrowed money, they want to make sure the value of their apartments will rise. But that's not the case if the population is declining. In most places throughout China, other than top-tier cities, it's very difficult to make the argument that home prices will continue to go up. A declining population is worsening China's balance sheet recession because people have reduced expectations of home prices recovering or rising. This is something Japan never had to worry about because its population was still increasing back then. So China today could be staring down a deeper cliff because the population decline started at almost the same time as the emerging balance sheet recession and deflation. On the other hand, the biggest advantage China has over Japan is that so many Chinese are already talking about a balance sheet recession. Back in the 1990s in Japan, no one knew anything about this disease. And if the Chinese government uses this advantage and puts in a big stimulus, then nothing may happen because the economy may not collapse. When Japan fell into balance sheet recession in 1990, a lot of people were in denial, like China today. They said real estate prices never fell for the last 55 years, so it would just be a small correction. But once people realized they were chasing the wrong asset prices, panicked and changed their behavior, that was the moment Japan slipped into a balance sheet recession. Question. How should Beijing navigate this external environment, marred by geopolitical rivalries and decoupling? Answer. The US, Europe and Japan, or the West, account for 56% of global GDP, and their average per capita GDP is $60,000. Then there are India, Russia, Africa and Latin America, which represent 26% of global GDP, with their average per capita GDP of $13,000. So it's like 1/5 of the West. I will recommend that China be a little more careful with its neighbors, because Americans and the West are watching very carefully. How China treats its smaller neighbors may affect the degree to which the Western market remains open to Chinese products. Question. What kind of advice do you have for China's depressed and disillusioned youth, some of whom are experiencing similar mental distress that became prevalent among Japanese youngsters a few decades ago? Answer. I remember that period well in the 1990s in Japan when companies were cutting hiring. Only those with good grades and excellent experience got jobs. Others had to lower their expectations. But in the meantime, Japan's GDP never fell below the peak of the bubble. So most people had a decent standard of living. Streets remained safe and clean, with social services readily available. So if GDP stays the same and your social structure remains intact and people help each other, then the recession won't be so bad. If the social structure and bonds are not so strong in China and things start falling apart, it could get much uglier. A lot depends on the society as a whole and how well young people will be able to cope with difficulties. And the challenges in China remain formidable because of high youth unemployment. I would argue that if young people think life is just like an escalator, you go to a good school, you get out of a top university and get a good job, I'm afraid that world is gone. The certainty is gone, and you have to be more flexible. You have to adapt. Here ends the quoting from the interview in today's episode of China Update. Thank you so much everybody for watching. Have a good Monday, and I will see you all tomorrow.